This chart tracks Costco's recent financial momentum. The company just pulled in $70.5 billion in a single quarter. Revenue grew 11.6%, net income jumped 15.2%, and digital sales surged 21.5%. These are the metrics of an absolute retail juggernaut, supported by a physical footprint of 933 enormous warehouses around the world, moving staggering volumes of inventory every single day. While these operational numbers are undeniable, the way Wall Street prices the stock suggests something else is happening. Investors have moved Costco into a different category than its retail peers, assigning it a price-to-earnings ratio that assumes this momentum is permanent. Today's share price factors in years of future membership hikes, international expansion, and digital capture that haven't happened yet. Buyers are purchasing a promise of flawless execution for the next decade. This creates a scenario where owning an elite business still carries the risk of a high-priced mistake. The real challenge is whether Costco can grow fast enough to justify the price investors have already paid for it. A typical retail transaction is simple. You walk into a store, buy an item, the retailer takes a margin, and the transaction ends. Costco functions differently, requiring an upfront fee before the first item ever hits the cart. This chart breaks down their total profit sources. Notice this foundational slice. That structural requirement generated $1.37 billion in recurring revenue last quarter alone. This cash flow exists entirely apart from the margins on milk or electronics. That fee changes how a customer behaves. Once the membership is paid, the shopper has a financial incentive to return frequently to earn back their initial investment through savings. This cycle maps out their feedback loop. High repeat visits generate massive sales volume. Costco leverages that volume to negotiate lower costs from suppliers. Those savings pass to the member, reinforcing the card's value and ensuring renewal, locking the flywheel into place. Walmart has tremendous scale, but lacks that same mandatory lock-in for every shopper. Amazon offers convenience, but it struggles to replicate the physical, accidental treasure hunt spending that occurs when a customer wanders into a warehouse. This economic engine justifies Costco's massive global scale. However, the reliability of this machine is also what drives Wall Street to demand growth rates that leave zero room for error. This comparison illustrates the math of scaling. Adding 10% growth to a $10 billion company requires $1 billion. Adding that same 10% to Costco means summoning $7 billion of entirely new business. As the company grows, maintaining a double-digit trajectory requires mountain ranges of new revenue every single quarter. Every additional percentage point of growth becomes a heavier lift. To beat this math, they're leaning into digital expansion. Online sales recently surged 21.5%, providing a high-growth bridge between physical warehouses and modern shopping habits. They are also increasing the productivity of their existing footprint. Comparable sales, the money generated by warehouses already in operation, grew nearly 10%, indicating that the current customer base is spending more per visit. Outperforming the law of large numbers suggests Costco is an elite operator, but it also places the stock at the very edge of an expectations cliff. The primary risk for shareholders is that Costco delivers good results instead of exceptional ones. This graph shows how a valuation trap functions. If Wall Street prices the stock for 15% growth and Costco delivers a healthy but lower 10% rate, the market will punish the stock. A company can be profitable and growing, yet still see its share price collapse if it misses a premium target. This vulnerability is tied directly to the American consumer. If household finances tighten, shoppers quickly reduce discretionary spending, slowing the growth investors bank on. To gauge the health of the investment, watch 3 operational metrics. First, comparable sales, then digital growth, and membership renewal rates. The final and most vital check is the valuation itself. Investors must calculate exactly how many years of perfect execution are already reflected in the current price. This contrast defines the stock today. On one side is a grounded physical business with loyal customers. On the other is a volatile market premium that demands constant, high-speed expansion. Operational success is only half of the story. The other half is the cost of entry. Investors must decide how much more growth Costco has to deliver before the reality of the business catches up to the price of the stock.